Are you recording assets and liabilities associated with non-lease components? There is a fine line on when this is appropriate action. Hi, I'm Priya Singleton, Quality Control Officer at Blue & Company. Let's discuss the various components of your lease contract. Broadly speaking, the cost included in your lease typically falls into three buckets. There is the lease component, which is any payment you make for the right to use the asset in your lease, like space in a building. The second bucket is the non-lease component, which generally represents payment for a service you're receiving in addition to the lease component, like common area maintenance or CAM, where the landlord is providing services such as landscaping and cleaning. And the last bucket is costs which are not considered components of the lease at all, because they do not transfer a good or service to you. These would be things like property taxes reimbursed to the lessor, that represents the lessor's cost, or building insurance, that is the lessor's cost. If there are non-lease components in your lease, you have a couple of options. You can either separate the lease components from the non-lease components by allocating the contract consideration to the components, or you can elect to apply the accounting policy election where the non-lease components are combined with the lease components and accounted for as a single lease component. This election certainly reduces the burden in separating multiple components and accounting for them separately. But keep in mind that combining these lease components means it is going to be included in your right-of-use asset and liability measurement, thus inflating those numbers. If you do not elect this option, you will need to 1. Identify the lease and non-lease component in your contract, 2. Determine the relative standalone selling price of each lease and non-lease component, and 3. Allocate the consideration to each component. Only the consideration related to the lease components are included in the lease payments. There are also gross and net leases to consider when measuring the impact of the right-of-use asset and lease liability. In a gross lease, the lessee typically pays a fixed base rent amount that takes into consideration that the landlord covers its estimated expenses for real estate taxes, insurance, and common area maintenance. You pay the same fixed rent regardless of whether the actual expenses end up being higher or lower than the estimated amount. Since the real estate taxes, insurance, and common area maintenance are included as part of a single fixed lease payment, the entire amount would be used in the measurement of the right-of-use asset and liability, meaning you'll end up with a larger right-of-use asset and lease liability. However, in a net lease, the lessee pays a fixed base rent and pays for their pro rata share of the lessor's actual real estate taxes, insurance, and CAM. Since the real estate taxes and insurance are already separated from the lease, and as we discussed earlier, they do not transfer a good or a service, they're not components of a contract. Accordingly, the real estate taxes and insurance would not be included in the measurement of the right-of-use asset and lease liability. This video should have provided you with a good overview of the various components in your lease contract. If you would like additional insight into these topics, please click on the link below and download Blue & Company's ASC 842 Lessee Implementation Guide.